Hello learners. In the past two lessons, we have learnt about theoretical concept of risk and return. We also had a little bit of the practice about the calculation of return. We calculated holding period return or holding period yield. We also calculated yield till maturity. Today's lesson is completely devoted to the practice session on risk and return. That means to say, we will be practicing on few of the questions, numericals, explaining or understanding how the return and risk is calculated. More particularly, this session is devoted towards calculation of return on equity shares. As you might be knowing, there are many mutual funds in the industry or in the India or in Indian financial market. There are many investors who are interested to calculate the return on their investment. Similarly, portfolio theory is there. People do it for the academic purpose or for professional purpose or for their portfolio evaluation. Then definitely they are interested to know how much return they have earned on the equity portfolio, bond portfolio, and so on. So let us begin with the practice session, how to calculate return and risk, particularly about equity shares. Now, if we proceed further, let us take an example. A share has generated following return in the past 5 years. Calculate return on this one. Now, before that, let me tell you, when we calculate return on equity shares, when we are calculating return on shares, definitely there are two angles or two viewpoints for calculating return on shares. We will be calculating historical return and we will be calculating expected return. We will be calculating expected return. Historical return is also called as past return. Now, when we calculate historical return is calculated whenever we are given past history of the return generated on a particular share in the stock market. And we will be given the data about that. So in some questions in the examination, you might be provided that so and so share has generated following returns in the past 5 years, 7 years or 10 years. Calculate mean return. So at that point of time, we are referring to calculation of historical return. So historical return means when we are given return generated by the share either in the past few months, month on month, past few quarters, quarter on quarter, or past few years, year on year on timeline. Scenario will be like this, like we might be given year 1, 2, 3, 4 and 5. I have taken till 5, you can have in practice more than 5 also. And we will be given how much percentage return has been generated on this particular share year on year. Let us see in the first year, return was 7%. Then in second year, it was 13%. In third year, it was -3. -3 means negative 3% return in that particular year. Then it might have generated 10% return. And lastly, it might have generated negative 2%. So this is the way we will be given the past trend line or timeline data. And now using this data, we will be required to calculate historical return, that is mean return on that one. So formula is pretty simple. Mean return or historical return on a particular share is calculated as summation Ri divided by n. Summation Ri divided by n. So it will be summation Ri divided by n. If you count on the n is 5. That means number of returns given to you. And we sum it up. So how much it becomes? So 20 plus 10, 30, 30 minus 5, 25. So your summation Ri in this case is 25. N is 5. So that becomes 25 divided by 5. It means we can say on an average, yearly return on this share has been 5%. Keeping this track record, now generally you come to know whenever you buy a mutual fund or mutual fund company or mutual fund itself is making an advertisement that our expected return or our track record of the return is 12%. Now, how do they give that track record? So simply, they might have referred to the historical data that in the past, the mutual fund generated so and so percentage return, which is likely to continue in the future also. Because sometimes we say future is the reflection of the past and something like that, or history repeats itself. So that is how this historical return is used by mutual funds or portfolio investors to predict how much they might earn as a return in the future. So historical return on a particular share is calculated like this, summation Ri upon N. Then that's what we have understood about how to calculate historical return on equity shares. So remind you, historical return will be calculated whenever we are given return data on the timeline. Similarly, we have something called as expected return, or which is called as ex ante return. Historical is ex post return, expected is ex ante return. Now, when to calculate expected return? Simple one. In the examination question, you will be given probability outcome and the return associated with that. If I say there is a 30% chance that a share might give 20% return in the next year, and there is a 70% chance that this share might give negative 10% return. Let me repeat it again. A share is there in the market, equity share. There is a 30% chance that it will give 20% return in 1 year time, and there is a 70% chance that in next year, by the end of next year, its return will be negative 10%. And you are required to calculate expected return or mean expected return. So formula for ex ante return or expected return is simply R bar is equal to summation Pi multiplied with Ri. Pi stands for probability of individual return, and Ri is itself individual return or percentage return. Now we can do it. You can continue in this table itself, multiply probability with the respective return. So what we get? 0.3 multiplied by 20, you get 6. 0.7 multiplied by negative 10, so you will get minus 7. So your mean return is simply negative 1. So we can say summation RIPI is negative 1%. So that is the way we can calculate expected return. So there are two concepts relating to the calculation of return on equity shares, which is generally employed by investors for judging the performance of their portfolio by mutual funds or portfolio planners. Historical return, like this, when data is given on time scale. Expected return or ex ante return, when data is given on the probability parameters. So that is the basic concept of calculating return with reference to investment in equity shares. So just a recap, holding period return is calculated whenever you are holding the investment for 1 year period. Whenever you are holding an investment, generally in debentures or bonds or FDR, for a longer time duration, that means it may be 3 years, 4 years, 5 years, or the complete tenure of the debenture, then definitely what we are referring to yield till maturity. And then the last concept about return, we have understood how to calculate the return about equity shares. Whenever we make investment in equity shares, we are interested to judge the performance of our investment in equity shares or equity portfolio. Historical return will be calculated whenever data is given on the time scale. Past performance is given. Whereas expected return is calculated whenever future performance is expected performance is given to us. So that is the way we calculate the return. Let us make some more practice on this one. So as you can see, a share has generated following return in the past 5 years. Calculate return and risk. Now how do we calculate that? Simply, we are given RI in percentage. So mean return, formula is handy with you. So we have R bar I, and I hope by now you can interpret we are referring to historical return because data is given on the timeline. Summation Ri upon n. So n again in this case is 5 by chance, but it need not to be 5 every time. And if you sum up these ones, so how much you get it? 15 plus 20 or 15 minus 5 becomes 10, 10 and 20, 30. So your mean return in this case will be 30 divided by 5, that makes it 6%. So we can say yearly return on this share has been 6% during the past 5 years. So let me remind you, these were the yearly data. If these are monthly data, that month on month we are given the RI values, that is return, we can calculate the mean monthly return. If these are quarterly data, then the result of mean will be quarterly average return. So mean return or average return is like that. Now on the same question, we have been told to calculate the risk. Now point comes how to calculate the risk. So risk calculation is simply standard deviation, or we can say variance is the measurement of risk. Because standard deviation tells us or signifies that how far the mean value might go up or down. If suppose we say mean return is 6% with standard deviation, so that is the symbol of standard deviation. So standard deviation, which we have measurement of the risk, is 2%. So in general, we are referring that mean return can go up by 2% or might come down by 2%. That means the normalization or normal curve will say like this: mean is at the center, 6%. When we say standard deviation is 2%, so return might go up to 8% or it might come down to 4%. That is one sigma concept. So idea of standard deviation is how far the risk is there. Larger the standard deviation, more will be the variability. Smaller the standard deviation, less will be the variability. So always remember, if a share is there with mean return 6% and a standard deviation more than the mean, sometimes it may be there. It means you might end up with negative return also. But general concept is there. In the stock market, we have higher the risk, higher the return. So on this side, we have risk, and on this side, we have return. So generally, higher the risk, higher the return, lower the risk, lower the return. So that is normal notion, but nothing is guaranteed. So how to calculate the standard deviation? So formula for calculation of standard deviation is simple. Sigma is calculated like this: summation deviations squared upon n minus 1. So I have used n minus 1. Now generally, whenever we work out return in case of a portfolio or individual shares, always refer to the situation. If we are given historical data for a period 30 or less than 30, then use n minus 1. 1 degree of freedom is kept under this. And if suppose we are given data for a period more than 30, then no normalization is required, no degree of freedom is required. So we take as such n. So generally in your examination question, your data might not be a larger one. It will be well within the 30 limit. So standard deviation is calculated summation di square upon n minus 1. Now you might be thinking what this di stands for. So di is simple. So let me erase this so that we'll have the clear picture. So sigma is like this. Standard deviation is summation di square upon n minus 1. So let me calculate the deviations. So di is basically Ri minus R bar. That means what we are doing, from the Ri values, we are deducting mean value. So our mean was 6%. So let me write down the mean over there. So our R bar was 6% which we calculate a few minutes ago. So 5 minus 6 makes it minus 1. So you have to take care of the symbol minus 1. 10 minus 6, you get 4. Minus 5, and from that you are deducting 6. So it becomes minus 11. So take care, whenever Ri is negative, symbol has to be put accordingly. So minus 5, from that you are deducting positive 6. So result is negative 11. Then again it will be 6, it will be 2. So deviations are like this. So sum of the deviation is not required right now, because if you do the sum, it might end up with the low conclusion, 0 will be there. Then we are taking deviations squared. That means these deviations are put to the power of 2. So this will remain 1. So negative will get eliminated. Minus 1 raised to the power of 2 will become positive 1. So this will become 16. This will become 121. This will become 36. And this will become 4. So deviations are squared up. Now you can take a sum of that. That will be sum of the deviations squared. So if we total it up, how much it turns out to be? 178. So we can verify our total. 17 plus 121 plus 40. 178. Now we can calculate the standard deviation. 178 divided by 5 minus 1. Okay, one more thing. For a standard deviation, we need to put a root over there. Because if we don't put a root, that will become sigma square. So we'll take a root of that also. So 178 divided by 4, that is 44.5 put to root 6.67%. So we can say there is a wider variability. Mean return was 6% with the standard deviation 6.67. It means what we have calculated so far, 6% was the mean return on this particular share and 6.67 was the standard deviation. So let me remind you, the formula which we have used is pretty simple. For calculating standard deviation, we have used the formula like this. Standard deviation is summation di square upon n minus 1, whereas if you don't take the root, that will end up giving you variance. So generally, when we talk about the variability, we make it a measurement in the terms of standard deviation. So that is how mean historical return and the risk of that return is calculated in case of equity shares. Now, we can proceed further. So that example we did it right now. We can proceed further with one more practice on the same kind of concept. How that practice will go about, let me tell you like this. Now in the previous example, we were given RI values. However, in some cases we might not be given RI values. Because your first step is you must be either given RI values, that is a percentage return. If not given, you will have to calculate it. So now I am depicting how to solve the examination question. Either you will be given RI values like we were given previously. If RI values are not given, like we are given 1 year, 2 year, 3 year, 4 year and 5 year. So during these 5 years, price of a share was like this: 100, 120, 110, 130 and 140. And now examiner wants you to calculate mean return and the risk of such return. In this case, we are not given RI values. So first step for you will be calculate RI values. So here we are going to calculate RI values. RI is pretty simple. When we calculate RI like this, we are referring to holding period return. It means P1 minus P0 divided by P0 times 100. Now remember, Either P1, P0 you should remember, or you can say PT1 minus PT0 upon PT0 times 100. 0 stands for the previous year or beginning of the year. 1 stands for the next year or end of the current year. Now in this case, for the first year we cannot have RI values because we don't know what was the price prior to that. So that cannot be calculated. We'll first calculate RI value for the second year. 120 minus 100 upon 100. It means as if someone purchased the share at rupees 100, at the end of 1 year or after 1 year, he sells it for 120. So if you purchase in first year at 100 and sell the same at 120 in second year, so your yearly return will be 20%. So your RI value in percentage is 20. Now, when we calculate for the third year, it means if you purchase the share at 120 in second year and sell it for 110 in third year, so how you will be there? So this will become your P1 and that was your P0. So we will have 110 minus 120 upon 120 times 100 definitely to convert that into percentage. So you are going to get negative 10. It means you have lost something. So negative 10 divided by 120. So you get 8.33% but negative return. Now when it comes to the fourth year, so you have 130 is the P1 and P0 will become this 110. So it will be 130 minus 110 upon 110 times 100. So we get it positive 20 on an investment of 110. So it is 18.18% positive return. Then similarly in fifth year, you happen to sell it for 140 because your P1 is 140 and your P0 is 130. So you are getting 140 minus 130 upon 130 times 100. So you get a positive 10 return over an investment of 130. So how much it becomes? 7.69. So just to remind you, if you are not given RI values, percentage return, and only prices are given over the time scale, it may be monthly, daily, yearly or quarterly. It may be monthly, daily, yearly or quarterly. And you are required to calculate return. Then definitely we have calculated first of all RI values. Now the steps are simple. Mean return will be like this. That means we are referring to R bar summation RI upon N. Now let me ask you, how much will be the value of N? In this case, since we are calculating mean of RI values, so how many RI values you have? 1, 2, 3 and 4. So your N is 4. So make a summation of this RI values, divide it by 4, you will get mean return. So it will be 20 minus 8.33 plus 18.18 plus 7.69. So it becomes 37.54 divided by 4. So 9.39%. So we can say mean yearly return is 9.39%. And then similarly, by following the similar steps of calculation of standard deviation, you can calculate standard deviation. So what I have depicted in this particular example, if you are not provided with the RI values, then definitely you will first of all convert the given prices into RI values. And RI means holding period return, P1 minus P0 divided by P0. So that care you have to take while solving the examination question. Calculate RI, that is the first step. Then rest of the steps are there, mean calculation, standard deviation calculation, and you get the good marks by following these steps. So that is the way we calculate historical return. Now let us proceed further. We will go for the calculation of expected return. Expected return or ex-ante return. As explained earlier, whenever we are given data on the probability parameters, that so and so probability is there for getting a return from a particular share in the future. It may be monthly return probability, yearly or quarterly or daily. Then we can calculate expected return or ex ante return. How do we calculate it? If you see this example, economic condition may be good, average or poor. Given the probability of that means there is a 30% chance, probability of 30% that economy will perform good, 40% probability average, and then again 30% with poor. With the respective probability, a particular share is likely to generate these returns. Calculate expected return. Now, formula for expected return is simple. Expected return can be calculated summation Pi Ri. So you will get mean expected return. Mean expected return. Now, how do we calculate it? It means what I can do, probability multiplied with respective return. So 0.3 multiplied with 30, you get 9.00. 0.4 multiplied with 10, you get 4. 0.3 multiplied with negative 10, so you will have negative 3. So if you make a sum of that, so that will be summation Pi Ri. So that becomes 10. So we can say mean expected return is 10%. Mean expected return is 10%. So that is how we calculate expected return or ex ante return. Then second part in this is how to calculate risk whenever probability parameters are given. Risk will be again in terms of standard deviation, but the formula for calculating standard deviation in this case will be summation Pi di square put to the root. In this case, there is no n. Role of n gets eliminated because for the each things we are given the probability. So what we are going to do, first of all, we will calculate deviation. Deviation is same, Ri values minus R bar I. So this is how we calculate deviation. So my mean is 10. We can verify whether we have done it right or not. Yes, 10 is the mean. So 30 minus 10, you get 20. 10 minus 10, you get 0. Minus 10 and minus 10. That means from negative 10, you are deducting positive 10. So you will end up with the negative 20. So by chance, some of the deviations is coming 20. But remind you, in case of probability data, some of the deviations might not remain 0. Now we do it. Raise this deviation to power 2. That means 20 raised to the power of 2, 400. This remains 0 and this becomes 410. So deviations are squared up and then respective probability is now plays the role. 400 multiplied with 0.3, that will make it 120. This remains 0. Then lastly also we have 400 and respective probability is 0.3. So 120. So we get it 240. So that is summation Pi di square. Now we can calculate standard deviation. 240 put to the root. So root of 240 gets me 15.49%. So now we can say expected return from this particular stock is 10% with standard deviation of 15.49%. That means return can fluctuate on either side, up or down by 15.49% from the given mean value. So if it goes up, it will be somewhere 25 plus. If it goes down, it will be negative 5, something around negative 5. So that is the way we calculate risk in terms of expected data or probability data. So dear learners, we have completed the concept or practice also on that one, how to calculate return and risk in case when shares, equity shares are there, historical data is given, we calculate historical return. Expected data is given, probability data is given, we calculate expected return. I hope you have learned the concept. My only submission is practice the things. Study material is also there with you. In rest of the lessons, we'll again do similar kind of theoretical concepts as well as practices. So till then, keep on learning. Wish you good luck. Thank you.